Opendoor Technologies, ticker OPEN, is currently trading live at $8.18. That is a significant intraday move, up about 21 cents or 2.63% on the day. The stock has been volatile, opening at $8 and trading in a range between $7.76 and a high of $8.25. All on very heavy volume that has already crossed 39 million shares just past midday. Now, the immediate insight, the thing that matters more than this intraday pop, is the staggering disconnect between that $8.18 share price and where professional market analysts believe this stock is headed. The expectation, if you follow the chatter on social media or look at the stock's incredible run-up from its 52-week low of just 51 cents, is that Opendoor is the comeback kid of the real estate tech space. The reality is that the consensus Wall Street price target isn't $10 or $12 or even its current price. The median analyst target is sitting at $1. That's not a typo. Citigroup is at 0.70 cents. Even a recent upgrade from Morgan Stanley only brought their target to $6, which is still more than 25% below where the stock is trading right this second. This isn't just a valuation gap, it's a fundamental disagreement about the company's very survival. Let's establish the common ground, the narrative that has so many retail participants excited. The expectation is that Opendoor, as the last major iBuyer standing after Zillow and Redfin fled the market, has weathered the worst of the housing storm. They see a company that has beaten earnings per share estimates for over 8 consecutive quarters. They see the talk of a pivot to a capital-light model, using artificial intelligence to optimize its platform and build a marketplace, Opendoor Exclusives, that functions more like a high-margin software business than a risky home flipper. This narrative has fueled a spectacular, borderline mimetic rise from the ashes, a 1,600% gain from its absolute bottom. The belief is that the bottom is in and the company is on a new trajectory. But the reality, the one those $1 price targets are based on, is far more sobering. The core of Opendoor's business is still iBuying. It buys homes, holds them in inventory, performs light work, and tries to resell them for a profit. This model is exceptionally sensitive to two things: home price stability and the cost of capital. We currently have a crisis in both. While home prices have been sticky, the transaction volume in the housing market has fallen off a cliff. Why? Because mortgage rates remain stubbornly high. This creates a lock-in effect, where existing homeowners with 3% mortgages refuse to sell, shrinking inventory for iBuyers to purchase. At the same time, high rates crush affordability for potential buyers, meaning Opendoor's inventory sits on the books for longer. And while that inventory sits, Opendoor is paying interest on the massive debt it uses to hold those properties. This brings us to the most critical recent development, the one that the market's current momentum seems to be completely ignoring. In the second quarter of 2023, Opendoor shocked analysts by achieving a positive adjusted EBITDA. This was the spark that lit the fuse, seeming to confirm the bull thesis that the turnaround was working. But in that very same report, management provided guidance for the third quarter, the period they are set to report on November 6th. That guidance was dreadful. They projected a return to a negative adjusted EBITDA and a massive year-over-year revenue decline between 38 and 43%. The market expectation is based on the Q2 result. The analyst reality is based on the Q3 guidance. The stock is trading on the past, while the bears are focused on the company's own forecast for the immediate future. Opendoor reports earnings on November 6th. Comment below with your revenue estimate. Do you think they'll beat the $882 million expectation, or is the company's own negative guidance the real story? The trading action we're seeing today, this 2.6% pop on heavy volume, looks less like fundamental belief and more like speculative momentum heading into that earnings report. Traders might be betting on another beat against lowered expectations, but the core business is facing immense macroeconomic pressure. The pivot to a capital-light model is a smart and necessary move, but it's a new venture. It's an attempt to build what Zillow already has, and it is far from certain that its commission-based marketplace can grow fast enough to offset the cash burn from the legacy iBuying segment. This AI narrative is powerful, but a sophisticated pricing algorithm is of limited use if the total number of transactions in the market has collapsed. This is where we must discuss the short-selling activity, because it's not what you think. Many online forums are filled with cries of manipulation or coordinated short attacks, but we have to look at the data. The actionable insight here comes from the short borrow fee rate. This is the interest rate short sellers must pay to borrow shares. Right now, the borrow fee for OPEN is incredibly low, sitting at just 0.85% as of yesterday. When a stock is difficult to borrow and under heavy short attack, this rate can spike to 20%, 50%, or even over 100%. A rate below 1% means the stock is exceptionally easy to borrow. There is no squeeze set up, there is no panic among shorts. The short thesis here isn't some hidden report from a small firm. The short thesis is the Wall Street consensus. The shorts are in effect the analysts at major banks who are publishing $1 price targets. Their thesis is not a conspiracy, it's a simple, cold calculation. Opendoor's business model is burning cash, its primary market is frozen, and its inventory is a massive liability in a high-rate environment. They are betting that the Q3 earnings report on November 6th will be the dose of reality that breaks the speculative fever. Investors looking for the shorts can find this data easily. You don't need a complex service. Your broker likely provides short interest data. You can look at Thintel or Ortex. What you'll find is not a stock primed for a squeeze, but a stock with a deep, fundamental divide between retail hope and institutional skepticism. What's your take on the analyst targets? Is a $1 price target realistic, or is Wall Street completely misjudging Opendoor's AI pivot? Let's briefly touch on what this company actually does. The premise was simple and appealing. For the expectation of convenience and speed, a seller could get a cash offer from Opendoor in days, avoiding the hassle of listings and showings. Opendoor would then take on the reality of that risk, using its data models to price the home, pay for repairs, and relist it, aiming to make a small margin on the flip. This worked beautifully when interest rates were zero and home prices only went up. It fails catastrophically when rates rise. As their cost of capital, the interest on the loans to buy the homes, soars, and the value of their inventory, the homes on their balance sheet, stagnates or falls. Zillow and Redfin saw this risk and terminated their programs, deciding the potential reward wasn't worth the balance sheet danger. Opendoor, on the other hand, chose to stay in the game. And that is the entire crux of the bull-bear debate. Looking forward, the future of Opendoor rests on a knife's edge. There are two very clear divergent paths. The bull case, the expectation, is that the Federal Reserve is forced to cut rates more aggressively in 2026 to stimulate the economy. If mortgage rates fall back to the 5% range, the housing market could unfreeze. Transaction volume would return, and Opendoor, as the last iBuyer at scale, would capture massive demand. In this scenario, its capital-light marketplace also grows, and the company finally achieves sustainable, positive cash flow. The stock could, from this $8, certainly re-challenge its former highs. The bear case, the analyst reality, is that these higher rates are the new normal. The housing market remains stagnant for years. The Q3 earnings call confirms the negative trend, and the company's cash burn accelerates. The AI pivot proves to be too little too late, unable to support the massive capital-intensive iBuying side of the house. This scenario, Opendoor is simply a 2021-era company that is incompatible with a 2026 economic environment. the stock's momentum breaks, and it begins a painful descent towards the $1 to $2 range that analysts have been warning about for months. The test is November 6th. The numbers to watch are not just the headline EPS, but the guidance for Q4, the commentary on their cash burn rate, and the current value of their home inventory. In summary, the story of Opendoor is one of the starkest expectation versus reality conflicts on the market today. Retail participants see a 1,600% gain from the low and a disruptive tech company that survived the storm. Institutional analysts see a cash-burning home flipper trapped by a frozen housing market with fundamentals that point to an 80 or 90% decline from its current price. The stock is trading on pure momentum, and that momentum is about to collide with the hard reality of the Q3 earnings report.